Hi everyone, I'm going to be talking about one of my favorite topics, dividend investing. Dividend investing can be a great way to build wealth and passive income over time, but it's not as easy as it sounds. There are some pitfalls and mistakes you need to avoid if you want to succeed with dividend stocks. So, in this video, I'm going to break down how dividend stocks work, how to find the best dividend stocks, and how to avoid the common traps that many dividend investors fall into. And as always, if you appreciate the value I provide in this video, make sure to smash the like button for the YouTube algorithm, and subscribe to my channel if you haven't already. It really helps out a lot, and it's totally free. So, with that said, let's get into the video. So, what are dividend stocks and why are they so appealing? Well, dividend stocks are basically stocks that pay you a portion of the company's earnings on a regular basis, usually every quarter. This means that you get two sources of return from dividend stocks, one from the dividend payments, and one from the appreciation of the stock price over time. This can add up to a very nice total return, especially if you reinvest your dividends to buy more shares of the company. For example, if you buy 100 shares of a company for $10 each, and each share pays a dividend of 50 cents annually, you would receive $50 in dividend payments over the course of a year. That works out to a 5% yield, which is pretty good. But if you reinvest those dividends to buy more shares, you would end up with more than 100 shares after a year, and your dividend income would increase accordingly. And if the stock price also goes up, you would benefit from the capital appreciation as well. So, you can see how dividend investing can be a powerful way to grow your wealth and income over time. But not all dividend stocks are created equal. Some dividend stocks are more reliable and consistent than others, and some dividend stocks are more risky and volatile than others. You need to know how to distinguish between the good and the bad dividend stocks, and how to avoid the common traps that many dividend investors fall into. Here are some of the things you need to look out for when investing in dividend stocks. The dividend yield. The yield is the annual dividend payment divided by the current stock price. It tells you how much income you can expect to receive from a dividend stock relative to its price. But don't be fooled by a high dividend yield. A high dividend yield can be a sign of a distressed or declining company that is trying to attract investors with a generous payout. A high dividend yield can also be unsustainable, meaning that the company may not be able to maintain or grow its dividend in the future. A high dividend yield can also indicate a low growth potential, meaning that the company may not have much room to increase its earnings or its stock price in the future. So, don't chase after high dividend yields without doing your research. A more reasonable dividend yield range is between 2% and 6%, depending on the industry and the market conditions. The dividend payout ratio. The ratio is the percentage of the company's earnings that is paid out as dividends. It tells you how much of the company's profits are being distributed to shareholders, and how much is being reinvested in the business. A low dividend payout ratio can be a sign of a healthy and growing company that is reinvesting its earnings to expand its operations, increase its market share, and improve its competitive advantage. A low dividend payout ratio can also indicate a high growth potential, meaning that the company may be able to increase its earnings and its stock price in the future. A low dividend payout ratio can also imply a safe and sustainable dividend, meaning that the company has enough earnings to cover its dividend payments and to increase them in the future. A reasonable dividend payout ratio range is between 30% and 50%, depending on the industry and the market conditions. The dividend growth rate. The growth rate is the percentage by which the company's dividend increases over time. It tells you how fast the company is raising its dividend payments to shareholders, and how much income you can expect to receive from a dividend stock in the future. A high dividend growth rate can be a sign of a confident and successful company that is generating strong and consistent earnings growth, and that is rewarding its shareholders with higher dividends. A high dividend growth rate can also indicate a high growth potential, meaning that the company may be able to increase its earnings and its stock price in the future. And also imply a safe and sustainable dividend, meaning that the company has enough earnings growth to support its dividend payments and to increase them in the future. A reasonable dividend growth rate range is between 5% and 15%, depending on the industry and the market conditions. So, these are some of the key metrics you need to look at when investing in dividend stocks. But you also need to look at some examples of dividend stocks to get a better idea of what to look for. Here are some well-known companies that have a long history of paying dividends: Procter & Gamble, 3M, Dover Corporation, Coca-Cola, Target. All these companies have increased their stock dividends for more than 50 consecutive years, placing them in an elite group of companies known as the Dividend Kings. They're also part of the Dividend Aristocrats, S&P 500 index companies with more than 25 years of consecutive dividend increases. Dividend stocks can come from just about any industry, and the amount of the dividend and percentage yield can vary greatly from one company to the next. I hope you enjoyed it and learned something you didn't know before. If you did, please hit the like button, subscribe to the channel, and share this video with your friends. And if you have any questions or comments, please leave them below. I would love to hear from you. Check out our next video and find out how to evaluate dividends and the dividend yields for the best chance of long-lasting dividend income to generate passive income and achieve financial freedom. Thank you for watching, and I'll see you in the next video.